So the first speaker is Neville Chester. He's one of the senior investment portfolio managers at Coronation. He's been there for a long, long time, one of the guys running the show there, and also involved in the Coronation Top 20 fund that we have been invested into for a long period of time, along with several other Coronation funds that we hold. Neville specifically is going to be talking today about something that is often asked to us as the multi-manager team and often debated, when you're around the barbecue or the restaurant table, which is, should we be taking our money offshore or exposing it offshore via the rand hedge type of stocks that are earning most of their revenue from offshore countries and markets, or should we now be tilting on its portfolio to more SA Inc., which are your domestic companies that generate most of their revenue from South Africa, and those would be things like the retailers, etc. So, Neville, great to have you on the show. We look forward to what you've got to say, and hand over to you.
Thanks, Trevor. Thanks for those kind words. Not so sure about the long, long time though. It certainly feels like it after a year like we've just been through. Thanks for the introduction. That's a debate, and as you said, it's you having it regularly. We having it every single day at Coronation. We're constantly debating that very issue. Part of the success of Top 20's return in 2020 was being heavily overweight the rand hedge shares and underweight domestic shares. But we're absolutely cognizant of what's happened in markets, the valuations that have come down significantly. By and large, we've actually probably been surprised at the margin at some of the resilience of those domestic SA Inc. shares. Having said that, we're still sitting with a position of being overweight the rand hedge shares. Now, I'd caution to say this is not a view particularly on just on global shares per se. In our multi-asset funds, we actually been reducing our developed market weighting in favor of increasing our SA equity exposure. But within that SA equity exposure, there are two particular buckets that we think are still attractive in terms of rand hedges. So first of all, the mining shares. We have been overweight resources for quite a few years in our portfolios at Coronation. And that's really, over the last 2 or 3 years, they've delivered phenomenal returns. The reason why we still think there's big opportunity there is it's a sector which has had significant underinvestment for many, many years, which means this cycle is very different to some of the previous commodity cycles we've seen. And as you said, we've been around for a long, long time, so we've seen many of them. We feel very comfortable holding them because due to that underinvestment, we still see significant shortage of supply coming into the market. And even though demand continues to grow, you haven't seen massive increase in supply. And even if some of those mining companies were to pull the trigger today on starting new mines or bringing on new supply, the leads and lags, it's typically 5 to 7 years before you would actually see any of that supply come into the market. So across the kind of key commodity baskets that the majority of these companies that trade on the JSE and Anglos, the Glencore, for example, we are still seeing a continued deficit, so we think the prices should stay high for quite a bit longer. And very importantly, is allied to that, these companies are not taking the cash generated from these good markets and building new mines. They're returning it to shareholders. So an environment where a lot of shares aren't paying dividends at the moment, and particularly some of your domestic shares, which are obviously under a bit more balance sheet stress and are worried about the economic environment, these companies are returning the cash to shareholders, and that's a fantastic way to get your returns. You're actually getting paid out, and the majority of these companies are on very significant free cash flow yields. So we still think that rand hedge of resources is attractive, and we still very much overweight some of the key holdings in our portfolios. The second bucket are, as you said, those global companies just happen to be listed on the JSE. And as I said earlier, we think global markets are looking quite full, but the specific shares that are listed locally, we still think have meaningful upside. So here, there's obviously the Naspers where, we're still sitting with a significant discount in that structure, and we think that's something that management are working to unlock, and we hope to see something in the near future on that. And that's that's on its own could release upwards of 400 billion rand of trapped discount into the domestic market. And then, some of the more unexciting, but again, solid cash generative companies like British American Tobacco, for example. Again, it just went ex-div yesterday. It's continuing to pay a good cash dividend in an environment where, as I said earlier, some of the other companies are constrained from being able to pay. There's a company called Quilter, which was unbundled out of Old Mutual. It's a UK platform business. We do like, and you will see it in top 20, even in our domestic holdings, the asset managers. Again, these are capital light businesses, still generating meaningful profits and actually able to pay that cash back to shareholders. So Quilter, we think it trades at a huge discount compared to some of the other UK platform businesses. And now that it's implemented its major system review, we expect that share price and that business to do really well from these levels on. And then, a homegrown business like Aspen, which, it's domiciled in South Africa, head office is here, obviously a big emerging market footprint in the pharmaceutical side. It's fixed its balance sheet. It's well positioned to benefit from vaccine rollout in terms of increasing the throughput in its facilities in South Africa. So, we think it's got a very interesting and attractive growth profile. And so those are the kind of global businesses, as I said, very specific stories which we think are still attractive. You counter that on the domestic side, we are absolutely cognizant that, there's a price for every asset. And, we have, through this kind of period of crisis, taken the opportunity for the domestic assets of the domestic companies that we do want to own by what we think are the higher quality businesses. We increased our holdings in some of the FMCG businesses like ShopRite, Spar, for example, that have actually managed to grow profits through this environment and actually are also, again, that keyword, still able to pay good dividends to shareholders. And I've referenced dividend quite a few times. South Africa at the moment is not attractive on the global investment stage. We went through, that decade of very strong price appreciation, the previous decade. Your marginal buyer was the foreign shareholders who are coming in buying South African assets. South Africa largely has gone off the kind of foreign investor radar. We know domestic funds are generally sellers of equity. We know, the UIF, in order to pay all the claims, have had to be a big seller of equities. We've got a shrinking formal savings pool. So really, to see domestic equity markets take off, you do need that marginal foreign buyer. And they're just not interested at the moment. There's more attractive growth profiles elsewhere. So if you really want to still get a meaningful return from these companies, a large part of it is going to come from dividends. So you do need to my mind, position yourself for companies that are going to be able to generate good cash flows and then importantly be able to pay that back to shareholders. So on the domestic assets, as I said, we do own those that we think are high quality, able to continue growing in a tough macroeconomic environment, and those companies that we think are still able to, capital light, still generating meaningful cash flows, and able to sustain dividend payments.
Great. Neville, just a question on the banks in South Africa. We've seen the last month or so, last few weeks actually, I think they've just already come out with their results. Most of them, their earnings were down between 45 and 58%, I think. Nedbank, I know, was around 56, 58% down. Just what is your guys' view on the banking stocks currently in South Africa? We sort of hear the opposing argument. Some guys think that they're cheap and are overweight them. Others are staying away. Just, do you want to give us your guys' view just on the banking stocks at the moment?
Sure. So, are they cheap? Yes. No, definitely. Do we see, superior? Do we think they can generate superior returns to some of the other opportunities in the market? No. So we are underweight banks. We do own some stakes in them, but we underweight the market. And, I think the banks delivered in a very tough environment. They actually came out with very good results. If you cast your mind back to a year ago, there was people running around trying to spread rumors that banks were going to go bust in this country. So the fact that all of them actually generated profits, I think it's a far cry from where people were thinking what was going to happen to them. But one can't escape the fact that given the size of the banking industry in South Africa, they are just inherently linked to economic growth in SA. And if you cannot see an environment where the economy is going to grow meaningfully, and I'm talking outside of 21, clearly in 21 there'll be a bounce off last year. The issue is in this environment where we're still expecting economic growth to be very anemic. It's very hard to see how the banks are going to achieve growth significantly ahead of that. In which case, they will kind of be, trundle along at low single-digit growth at best, I think, in the loan books, and facing all the same kind of cost pressures that banks are facing elsewhere. So cheap, yes, but definitely think that there are better opportunities in the market.
Neville, great. Thanks for that. Last quick question, and I know it's probably putting you a little bit on the spot, but I'm sure it's something that many of the people that are viewing us today would like to know. Just forecasting is definitely not Coro's game, but I know you guys work out perhaps expected returns across the asset classes, particularly in your multi-asset funds, etc. Yeah. I mean, and I was quite surprised, or we've been surprised at how strong all markets in South Africa as well. I mean, we're up 55% since March last year, post the COVID crisis, the all-share index. But looking forward on whether it's a 1 year or a 3 year view, perhaps, what is Coro roughly expecting? What are your expected returns for equities?
Yeah. So as I said earlier, I mean, we are actually quite optimistic on the returns that the JSE is going to be able to deliver. We think broadly assets are cheap. I mean, domestic shares are cheap. The resource shares are cheap. We think the specific global shares are cheap. So we have, as I said earlier, increased our allocation to domestic equity and reduced our global equity. I mean, clearly, those remarkable returns globally have been driven by this, a wash of liquidity. And South Africa hasn't benefited from any of that yet. In fact, we've gone the other way. So in our kind of 3 to 5 year forecasts are looking for mid double digits, so kind of 12 to 15% potential market return, and then the ability for alpha to add a couple of percentage points over and above that. So after a decade of fairly mediocre and 5 years of very poor returns from domestic equities, we actually are quite optimistic on the future outlook for the SA equity market.
Thank you so much. Appreciate your time and comments and insights, and we certainly have faith in Coro to deliver on those expected returns. So that's great. And thank you for your time.